Welcome to the Real Estate Investing Club. This is the place everyday real estate investors gather to share their best stories, biggest insights, and favorite tactics to grow a portfolio of cash flowing properties in today's market. Here's your host, Gabe Peterson.
All right, we are back with another episode of the Real Estate Investing Club. I hope you guys are having a great day, whatever day it is for you. Usually we do this on Friday, but today is a Wednesday because it's a unique day because we had the opportunity to get Gino Barbaro on the podcast here. I always love talking to Gino. He's been on the podcast before, so I'm sure you guys remember those episodes. He really brings the fire, so I'm excited to jump into this. For you guys who are not familiar with Gino, he is from jakeandgino.com. They have, I can't remember, some 1,800 or something multifamily units. They are crushing it in the multifamily space. They do coaching, and Gino has recently launched a book called Happy Money, and he talks about mindset with money. So it should be a good episode. Gino, thanks for hopping back on the show.
Thanks, Gabe, for having me back on. How's it going, brother?
It's going well, going well. We've already, on this podcast, we've already gone into your story a little bit, but I always like to kind of refresh people so we don't have to hover on it too long. But I know you have a good story about how you got into real estate, how you got to where you are. So why don't we just start there and just take us through the beginning phases of your career in real estate, and then we can get to the current day.
Sure. Real quick, this is important. Had two parents. They're both immigrants. And we'll get into why that's important for my story about money. But listen, both my parents are hardworking immigrants. They started a restaurant. I was 8 years old. I worked with my dad until I went to college. He made me go to school because you got to go to college, get a good job. Got a good job for a year. That's all I lasted. The cubicle space was not for me. I was working downtown in New York City back in the 90s. I just dreaded it. Got into the restaurant business with him and the family. Loved it until I didn't love it. Until, the 08 recession came, everything changed. Fortunately, I had made a couple of bad real estate mistakes. I say fortunately because I learned on the street. I decided to go learn in the classroom. I went through a couple of mentorships. I met my business partner, Jake, who was a pharmaceutical rep, hence the pizza guy and the drug rep. Launched our real estate careers in 2011. We bought our first deal in 2013. And 5 years later, we probably had around 700 units. And to date, we've transacted on over 2,200 units. We currently own 1,870 in the portfolio right now. No syndications. We've had syndications, but we've sold out. So it's our own capital right now. And we could take this conversation in so many different directions. Gino, how did you go from one restaurant for 20 years to a couple thousand units? Gino, How did you go from the restaurant business that was in your blood for 20 years and decided to make a shift into something completely different? You're a pizza guy. How do you go into raising millions of dollars and building another business? There's so many different ways we can tackle this. And I just love to be able to, share anything that you think the listeners would love to listen to.
Yeah, absolutely. First of all, I didn't actually know that your restaurant was a pizza restaurant. That's I feel like those have to be the type of restaurant that are really difficult to get profitable. So I feel like that was probably a good lesson for you, at least starting in business.
It's one of those things where if I had done it the right way, and I had really we had a nice little brand, and I was on the precipice of scaling. It was 2011. I wrote a cookbook. I started creating physical products. I started doing YouTube videos, and I started building the brand around it. My brother wasn't there. He was my business partner. I'm like, bro, let's start opening up other little stores. We can start really creating a really cool brand and feel around it. We can start doing monthly subscriptions. We can start doing coaching classes. We can start doing lessons. It could be amazing. And he just wasn't there. And business is business. You can do this. It transcends all different platforms. And for me, I had really struck upon multiple streams of revenue. We wrote the book, The Honeybee, and you think about your core business. Let's say this is real estate. For me, it was the restaurant. All of a sudden, you have that one little brick and mortar place. And from there, you can just start expanding. We started doing catering. We started doing wedding events. We started doing backyard barbecues. We started doing all these different ancillary revenue streams attached to that one business. But for me, I wanted something bigger. I wanted to create a brand. I wanted to get out there. And unfortunately, at the time, my brother wasn't ready, and I got fed up. I met Jake. I'm like, this real estate thing is really an amazing tool. If you've got a little bit of time and you have a long-term vision and you're able to reinvest back into the business, you can create some serious wealth by investing in real estate. And that's what attracted me to real estate.
Well, we are glad that you took the leap into real estate because you helped a lot of people. I've actually had some of your students on the show about they're growing their multifamily portfolio. Yeah. So it's good to see that you've had an impact on the industry. So it is, you mentioned, it took 5 years to get to 700 units. And that is, 700 units is life-changing money for the vast majority of people. That gets you to the point where you don't necessarily need to work anymore. And you, if you wanted to, you could retire. Obviously you didn't, but you got there within 5 years. And before that, you'd been working 20 years as a business, running the pizza shop. So that type of transition, that type of growth in such a short period of time, there had to have been some flexion points. There had to have been some moments that you kind of, your mind was opened and you realized what you were doing wrong, and all of a sudden the answers were in front of you. So take us to those moments in those first 5 years. What were some learning or some growth periods that you had that you can share with us?
For me, being in the restaurant, I had a certain paradigm of the way I looked at business. I learned from my father, who back in the 70s and 80s, it worked really well. You have one location, you work really hard, you take care of your little baby, you show up, and you can make a really great middle-class income. That worked in the 70s and 80s and early 90s. The model shifted. All of a sudden, my dad's like, you got to be there all the time. You can't scale. You've got to be the cook. You've got to be the dishwasher. You've got to answer the phone. And I'm going to do this. I'm going to do that. I'm going to get burned out. And there were so many inflection points and understandings of why I couldn't scale that business. But for me, that's what it was. I had to disassociate myself from the restaurant industry, even though it is a difficult industry to scale, a lot harder than real estate because food is hard. It's really location central. The people you hire, the ingredients, whatever, that's challenging in and of itself. But there are systems that I didn't have. And systems seem really, really complex, but they're really not. How do you pick up the phone? How do you greet a customer? How do you drop a check? How do you take an order? All of these things, we didn't have these things documented. That's the first thing. That's why I couldn't scale, number one. Number two, I had no mission statement and no core values. How am I supposed to hire and fire and lead without those? Now, you may be saying to yourself, well, I don't really need that. I'm only buying a couple of units. It doesn't matter. You're at one point going to hire a resident manager. You're at one point going to be dealing with vendors. You're at one point going to be dealing with residents, and hopefully investors and partners. Have a vision for your company. Have a mission statement.
Jump in there real quick, because that's one thing that I kind of have an issue with, is that people always, when they're talking about real estate, they're talking about real estate investing. And
yes,
when you put the investing at the end, it always seems like a passive thing, like you invest in the stock market. But it doesn't matter what you buy. Every piece of real estate that you buy is a business. It's like you have to run it as a business, and you can't think of it as an investment. It is an investment. You are investing your money, but the operations, the day-to-day, that is a business. And so I'm glad you brought that up, because I just don't like the framework that people put real estate in.
That's probably the most important thing and probably the smartest thing that we're going to say in the podcast. So we could just end it right now if you'd like. but seriously, this is the mistake that I made early on when I was by myself, when I had no map. It's called buy right, finance right, and manage right. There's the operation side of the business. For someone stroking a check, it may be passive. Somebody has to have the baby, and then somebody has to raise the baby. That's how it goes in real estate. And that's great, because all of a sudden you can affect change. You can affect an increased NOI. If you understand that every deal you do, we have probably over 30 different LLCs, 25 unit, 12 unit, 156 unit. We just bought a 4 unit, closed on 63. We're selling 18 this month. All of them, if you can think of it as each deal is an individual cash generating machine. You're buying a future stream of revenue from every single property you own. And the way we look at it is our KPIs, or our key performance indicators, something that I didn't have at the restaurant, because if you can't measure it, then you can't manage it. I wasn't measuring very much at the restaurant. But all of a sudden here, our KPIs are PPU, We want profit per unit. That's why we're not really high on syndication, unless we can put a lot of our own money into it. We want to be able to buy a property, reposition it, and then affect at least $250 to $300 in profit per unit. That's what we're looking for.
That's cash flow profit?
That's cash flow profit after all of the bills. And that's what we're doing. Last month, we hit a little over $275 per door on our portfolio. But you have to buy them properly and you have to manage them properly. And what you said about it, if you go into the business, I don't care what you're buying. If you're buying a single family home, if you're buying a self-storage facility, if your self-storage looks more like a business, but it's the same concept. Mobile home parks, retail, you are buying businesses. And once you understand that, it's pretty cool because then you can implement systems and processes and you can scale those businesses and you can add employees and you can start growing the portfolio properly. When it was just Jake and Gino and we're running around and we have, 2 deals, we have 2 resident managers, that inflection point for us was our third deal. We bought our first deal in January of 2013. In July of 2013, we bought our second deal. It was a 25 unit, then a 36 unit. So we've got about 60 units. We're managing it ourselves because we don't know what the hell we're doing. We want to save on the property management fees, and Jake wants to get out of his job day to day. So, hey, let's make 6% of the gross revenue. Jake, you take it as a property management fee. We'll control it. We like to learn. We're kinesthetic learners. We learn by doing. And then all of a sudden, February 14th of 2014, we closed on 136 units. We had a really great business partner who had a strong balance sheet. He actually lent us $500,000 as part of the down payment for this deal. We got up to 200 units. All of a sudden, we don't know what the hell we're doing. We're like, we need to hire property managers. We can't be cutting the grass. We have to it's property's 80% occupied. We got 40 vacants. What do we do? And game was on, but everything changed from there. And if you can understand that when you get into real estate, you need to have the operations side and the asset management side. So you're property managing the property, which is the customer service, the customer journey, the customer experience, the outward facing. Then you have the asset management side where you're actually running the budgets. You're talking to investors. And for us, we were wearing both hats because we were managing the properties and we were also asset managing for ourselves. We didn't have investors. But if you can separate and delineate those two functions, and if you're doing it yourself, great. But they're different because when you're talking to your residents and you're talking to your property managers and your maintenance techs, that's one thing. But when you're trying to create owner draws and you're trying to create profitability, that's another thing. They need to learn how to work together to be able to be profitable in this business.
Before we continue on with today's guest, I want to tell you guys about a community I'm launching on School to help investors like yourself grow your own portfolio. In this community, you'll get access to all the docs I use, all the systems I've built, everything I've used to grow my own portfolio, as well as instructions and guidance on how to get out there and find great deals, how to finance those deals, and then how to manage them for great returns. Since we're just launching it, the price will be set at a measly $20 per month, and whatever price you join at is the price you'll have for life. We will be increasing the price as the group grows, so if you're at all interested in growing your portfolio along other investors, now is the time to join. I will put the link somewhere in the bio or on our podcast website at therealestateinvestingclub.com, so if you are interested, head on over there. With that said, let's get back to the podcast. Interesting. Okay, so you separate property management and asset management. I mean, you separate them in your mind. And when you're talking, I usually put managing property managers as a function of asset management. But you think of asset management as that is basically the investing side of the transaction, the dealing with anybody who's put their money into it, dealing with the P&Ls, all the financial aspects of it. Is that?
Yeah. As you start scaling, Gabe, that's the hard part of having a syndication company because the syndication company's out there raising money. When you're in real estate, there's two things you're doing. You're either sourcing capital or you're sourcing deals. Sourcing deals is a lot of fun. Sourcing capital can be painful, but that's a full-time job because you've got an investor on your list. You need to keep that investor warm. You need to be able to talk to the investor and not just go to the investor when you've got an opportunity. So that in and itself is part of the asset management of managing the investors, but also creating budgets, executing the business plan, and then having your asset management team talk to the property management team, having those weekly, what we call level 10 meetings, having a weekly pulse sent out by the property management to the asset management, and having those two talk about what's going on. Why are delinquencies higher this month? Why are we having so many leases expire? They need to be working together, because if the property management's goal is, hey, we're just going to try to fill as many butts and seats here, we're trying to hit our numbers because we're basically working on a what you call it, where they're trying to get money and fees over here. The asset manager is like, hold on a second, we have some strict adherence here. You can't just put anybody in those seats. We have to adhere to a budget, and we have to make sure that it makes sense. So I like to separate both of them. When you're starting out, you obviously are going to do both, but as you start scaling, if you want to get third-party property management and you become the asset manager, great. But even if you're the property manager, what's interesting, Gabe, is when we started, my business partner made me understand that Jake was the property manager. He was getting paid before the ownership group was. There may be a little bit of conflict of interest there. Jake's getting his property management fee. Is there any money left over to pay the owners? Very interesting. I mean, if you don't have a strong relationship and you're not really dialed in, all of a sudden Jake's making money on his fees, but why aren't the owners making any cash flow? That's where it can be a little difficult, and maybe a conflict of interest. And all of a sudden, what do we need to do to right the ship on that? That's something you have to think about when you're wearing both hats.
So at what point did you switch from, or do you guys use third-party property managers today, or
no,
are you guys all in-house?
We're still vertically integrated. And let me touch on that real quick, why we are. We read the book called Small Giants by Bo Burlingham, and we realized, Jake and myself, that we wanted to create a really cool family-oriented company that had culture. We wanted to be able to really, I guess, control our own destinies. We didn't want to have investors as our bosses. We had that, but we decided, you know what, we want to become the small giants in multifamily, where we have our own properties and we actually own the equity ourselves. We can make decisions based on what we want, because when you have investors, it's not about you. It's about what's best for them. And you're on the ride with their capital. You have to understand that. You're their fiduciary responsibility. So for Jake and myself, it's, hey, what's best for us? And we want to we have a really profitable company where, like I said, we're focusing on the profit of every unit that we have in our portfolio.
Yeah, that's one reason. I feel like syndications are kind of it's like a necessary evil along the trajectory of your career. Because I don't like syndications. I just don't like having outside investors in the deals, because it just puts an extra layer of stress on the transaction.
Yes.
And ideally I would just like to buy these properties myself, but you get to a point where your capital, you run out of capital as you're growing your portfolio. And so it comes to a point where you need to take on additional investors. So that's kind of, I don't know, it's a difficult road to run there, but it's a good point made.
Well, we went through that. We started in 2011. We bought our first deal in 2013. By 2016, we had probably around a little over 600 units. We were able to refinance probably around $8 million on that first round before we ran out of money. We ran out of money in 2018. We're like, okay, everyone's talking about this syndication thing. What's this syndication thing? The 2017 Jobs Act came out, and all of a sudden, raising capital became more mainstream. Years ago, it was more backroom deals. It was more people who had bigger lists, more private equity. But in 2017, it came to mainstream. We're like, we need to learn this business. And we started syndicating deals because of what you said. We sort of ran out of capital, of our own money. We did 3 syndications in 2018 and 2019. And we're like, okay, time out. COVID's here. We don't know what's going on. We don't know how many deals are going to be. Let's just focus on our portfolio. Let's stabilize everything. And as we saw where the market was, we're like, let's take these syndications. We need to make money for our investors. So we're focusing on IRR. Whereas now Jake and I, we don't focus on IRR in our portfolio. We don't care about IRR. We care about investing in a deal, cash flowing it, pulling all the equity out, and going to the next one. That's what the focus is when you're investing your own capital. But with the syndication, it's a little bit more of a fix and flip model, unless you can, if you look at it in the fact that, hey, I bought this syndication, I can refi this deal. If I've done the operating agreement correctly, I can give a lot of the money to the investors. I can keep some, and then we can continue operating this deal. But most syndicators don't look at it that way. Ken McElroy is famous for doing that model. He's been doing it for 30 years. He's been super successful. I love it because you've got investors, you've got their money, you've made them money, you're giving them their money back. You're keeping the asset because you bought a great deal. You're continuing to run that asset. And then when you find the next deal, guess what? Your investors are going to jump in because they've had success on this prior asset.
Yeah. Yeah. And that's all. I mean, that's contingent on whether you can refi,
Yes.
3, 5, 7 years down the road and get them their IRR. If you're promising 18, 20%, whatever it is.
Yes.
And which is, it's possible, but with a refi, sometimes it's difficult. So
it is.
Yeah. So, I mean, this is a short form podcast. We always keep it around 20 minutes. And I know you wrote your book, Happy Money. I want to talk a little bit about that, what kind of inspired it, and what is give us the core message there.
When I say the word money, what's your initial reaction? What do you feel in your body? I mean, like, what's the visceral reaction?
It feels like a tool, like something I'm going to use.
That's actually pretty good, because most people, when they hear the word money, they pucker up a little bit, or they're not really sure. It's like the last taboo subject we have in this country, which is actually pretty weird if you think about it. But for me, teaching people and coaching people, I was always amazed at how some people were super successful that had no business being successful. And then you had others that had all the trappings. They had all the balance sheet, the net worth, and yet they couldn't close a deal. And I kept going back and forth and saying, what's the difference here? And you had talked about it before we started recording. It comes down to mindset, number one. But I think number two, even more important, is a person's relationship with money. And if you have a healthy relationship and you understand that it's a tool, you're not working for money, you're working to create value. And the more value you create, money is just the end result. See, there's more of a healthier relationship and a healthier outlook with money. The old Gino was, no, I need to save. That was my money persona. That was my money script. I can't risk my money. I need to save my money for a rainy day. Never a sunny day. Always a rainy day.
And always you're just waiting for shit to hit the fan.
Yes. So if you're waiting for shit to hit the fan, it's going to hit. If you're waiting for opportunity, then opportunity is going to come. See how the mindset, see how that speak? So if you have a really good relationship, and what do I mean by that? Go back into your childhood when you were young. And what did you hear about money? What was said about money? What wasn't said about money? These are all things that you carry into your adulthood. And then I want you to take a chance. If you're married, if you have a spouse, boyfriend, girlfriend, talk to them and see how they were raised. And you'll be amazed that a lot of the fights that you have in your relationship really aren't about money. Money's the symptom. And see what's the underlying effect. What you call your money personas. Were you a saver? Were you a spender? Were you a gambler? Were you an innocent? You had no idea. Were you an avoider of money? Well, if you bring that into your adulthood, you're creating patterns from childhood to adulthood, and you're continuing these patterns. I was fortunately able to understand this, and when I went to coaching school, I was like, this is great. I need to go forward. I need to create success. The problem was I was lacking this one last element of, becoming a money coach and understanding that we need to go back into our past, look at our money bio, ask ourselves these questions, see what was going on, come into the present, look at what's going on with these patterns, highlight some of them. Some of them are great. Some of them aren't so great. And let's talk about where we are right now and what your sole purpose is going forward. How are you going to affect that going forward? But you can't go forward unless you look back and at least acknowledge the past and see what happened back then and try to a lot of us have gone through money traumas. A lot of us have gone through things where we couldn't afford something. People were really negative about money. We were scarce about money. And if you bring that into your adulthood, you're creating actions and you're taking paths and you're making decisions unconsciously. And I just want people to have a conscious awareness of it and say, hey, I want to continue this behavior and I want to stop this behavior because it's really hurting me. That's what money coaching is all about. It's just, It's an incredible way for you to really see what was going on in your life and say, I'm here right now. Let me become responsible for my actions going forward. What do I need to do to accomplish those actions?
Yeah. Yeah. And when I look at my own life, I started out, had no money and took a bunch of leaps and finally got some stuff rolling. But in those moments when I had like zero money, I feel like the thing that allowed me to get to the mindset to where I can think of it as a tool and I can think of it as a tool that I can use to build wealth. I needed to actually get money first. And it's like a chicken and the egg thing in my mind. Cause I was just thinking, when we were talking earlier, At what point did my mindset shift to where now I think a bit more freely with money, and a bit more like a tool, it has a use versus something that I need to hoard and I need to be scarce about. And the only thing that kept popping up in my mind was, well, once I got money, then I could be free with my money, but I needed to get there first. And so it's kind of, it's like a chicken and the egg. How do you
Think
get
about
that
that.
mindset that is required to create money, but before you actually have the money itself?
It's actually an illusion if you think about it, because you're already free to begin with now. You don't need money to make you free. That's the illusion. So we grow up in that scarcity mindset of saying, hey, but my parents kept telling me, you need to save, we need to save, we need to save. I was okay without money. I just became, when I got married, what we call the tyrant. I became really controlling because I was afraid of the future. I wanted to control. And then you start taking actions and you think money's the problem. Money's not the problem. You had mentioned it. It's your mindset. It's the way you think about it. It's the way you've learned about it. And then you bring it into your adulthood and you're taking these actions and saying, man, I can't spend $5,000 for my kids' braces. What are you talking about, Jewel? We can't afford that. When obviously I could afford it, but in my mind, if I'm spending that $5,000, I'm not going to have it to put them through college or to put them through whatever. And you're making these decisions based on the mindset that you had. It's pretty incredible. It's pretty enlightening for a couple to go through that.
Yeah. All right. So I do have to move us on. So your book, Happy Money, where can people find that?
Just go to barbaro360.com. It's BARBARO 360.com. You go to the website, you can get a free download copy of the book. I mean, it's happy money, happy family, happy legacy. To me, all three of those work in conjunction. You're making money, you want to get a happy family, and obviously that last component of creating a legacy for your family and teaching your kids the life of abundance, and not only just leaving them money, but leaving them your values and leaving them what you think is important for the family unit, having a mission statement, having core values and a culture for your family, and leaving that as part of your legacy.
Nice. I love it. All right. With that, I'm going to push us into the quick question round. Are you ready?
Ready?
Let's do it. It starts with education. It is a big topic, and so we're gonna open it up to not only books but also conferences, mentorship programs, anything. I need 2 recommendations: one for general life wisdom, and then one for real estate.
So general life wisdom. Right now, I'm going to a lady called Deborah Price. She works for the Money Coaching Institute. Not getting paid to promote her. I just started this 2 months ago. And I find it incredible. It is an incredible way to look at money. And it's really a little bit of therapy, a little bit of coaching, a little bit of money. Finance is easy. Financial planning is easy. 1 + 1 is 2. It's about math. Why can't people figure it out? Go check out the Money Coaching Institute. And general real estate, general business, there's so many different mentors out there. If you're looking for a certain niche, go to ChatGPT.
I'm going to throw Jake and Gino out there because I have had your students on and they are crushing it.
They're
so
great.
I'm going to put that. I know you're not going to say yourself, but
thank you.
I will say you guys do have a good program.
Thank you.
But what was your recommendation? I cut you off.
No, I mean, just for me, just Google the niche that you're in. There's so many different conferences out there as far as multifamily, mobile home parks, self-storage. I would go to Bigger Pockets, honestly, and just start perusing their site and seeing who the thought leaders are on there.
Perfect. All right, let's go back to your younger self. Let's go back to the Gino who was just, it's the last day in the pizza business that you ran with your dad. It's that last day. Go to him, look him in the eye, give him one piece of advice moving forward.
Wow. Just one piece of advice, huh? Marry Julia. My wife. That's all I'd say.
I love it. That's good. You're the first person to say that, and but that's really good advice because who you marry it's a huge thing. You're going to be with them more than pretty much anyone else in your life, so it's a huge decision. So having a good decision with your marriage partner, that is great advice. All right, I know you guys are focused in on Nashville out there. I'm going to ask this anyways. The United States is a big place. There is a lot of opportunity out there. Give me the single metro you're most excited about investing in today.
Wow, that's a great question. I would say Dallas, Texas, and no further reason other than once they get their supply issues worked out, everyone's moving to Dallas. And what's going on in New York City, I don't know if it's going on with the mayoral
Yeah,
People are
I
going to be
saw
fleeing
that.
the people are going to be fleeing these blues. They're going to be fleeing them even more. And Dallas has got over 800,000 multifamily units. It's incredible. It keeps growing. More
Wow.
Fortune 500 companies are going there. The metro keeps getting bigger and bigger and bigger. And for me, I'm not a huge fan of Florida. I think Florida is just overpriced still right now. There's just tremendous population growth, great capital appreciation. South Florida is a little crazy right now. The pricing is a little crazy. I like North Florida. I'm in St. Augustine, but the pricing here is a little crazy. I like Texas, and I also like Tennessee. Places that have lower taxes, more freedoms, are pro-business and pro-landlord. That's what I'm really looking forward to when I'm looking at a market.
There you go. DFW, man, that's one of my favorites. We have 2 self-storage facilities out there. We're always looking for more. Everybody likes DFW, but a lot of investors that come on here, they say that metro. So good shout out. Moving us on to the next question. This is about finding deals. It all starts with getting in contact with the seller and penning that purchase agreement. So what is your favorite way to generate leads and find new deals?
I have just taken over acquisitions for my business partner, Jake, and myself. He was doing it, but now, you know what? Over the last 2 weeks, he's like, bro, I need some help. I said, great. I got a list of brokers, went on chat. I said, give me the top 30 brokers in Knoxville. Got them all printed out. I already had a list. And first thing I did is I went on LinkedIn, make sure that I was connected with them. If I wasn't, sent out a note saying, here, you know what? I am going on. I'm going to, take over acquisitions. We've got 1,800 units. Let me introduce myself. That's the first step. I think the next step for me is, hey, Jake, let's create a really cool email, just introducing myself again. Let me send that out. The next step is I'm going to actually give them a call and or text. You need to reach out to the top 10 or 15 brokers. In any metro, Dallas is a little odd because, like I said, there's so many brokers. But in Knoxville, there's probably 10 brokers, 10 multifamily brokers that you really need to know. And then you start just going out to the periphery. Then you may go to land brokers or you may go to small multifamily brokers, but you really need to introduce yourself. And now's the time because there's not a ton of deal flow. They're actually going to return your phone call because they're just as hungry. It's not like it was 2 years ago where they didn't need you. Now they sort of need you. So there's no excuse not to be talking to brokers right now. And I know it's scary. Just have your criteria. Just have a conversation. Just tell them that you're in the business, that you want to be in this business long term, and this is what I'm looking to buy, and I'd love to connect with you. If you've got anything, please send it over to me. And if you're on their website and you find a deal, call them up and do a property tour. Don't be a tire kicker. Get on site with them and talk to them. I know everyone likes to sit in front of a computer and love the AI and love the chat, but at some point, shaking a broker's hand, looking them or her in the eye and saying, hey, nice to meet you. What deals you got? There's nothing better than doing that. You got to get out there. And then you can always do those direct to seller stuff. That's great. I'm a fan of that. Go on Crexy. Crexy's got a great platform as far as aggregating data, spending a couple $100 a month for their platform. But for me, really is trying to find out who the major brokers are, at least in multifamily. It's not an MLS driven market. It is a broker driven market where we are. Other areas it may be MLS, but you need to get in front of as many brokers as you possibly can down here.
Nice. I like that response. Specifically, you said it was kind of like multiple ways you're reaching out. Reaching out on LinkedIn was the first thing you said, and that is something I haven't even thought about, but I think it's a great way to do it. First, you said go to chat, ask who the biggest brokers are. That's a good idea. I am absolutely a huge fan of AI. I've been implementing it in as many areas as I can in my business, and doing things like lists. AI does a really good job with. So go on to AI, get a list, and then reach out on LinkedIn. I like that answer. It's a good way to do it. And then you said also give them an email and call. So that's I like that. Moving us on to the next question. This is about lessons learned. Not every deal that we get into goes the way we expect it. In fact, many times things go wrong, and that is when we get to learn a lesson. So what was a deal that went a little sideways for you? And then what was the lesson you pulled from it?
Any deal that has gone sideways for me, it's because I never followed or I didn't follow the buy right, the finance right, the manage right. And more specifically, what we call something called the 3 pillars of real estate: the market cycle, the debt, and the exit strategy. We bought in the wrong part of the market cycle, or we didn't have an exit strategy, and or we didn't have a great buy right criteria. The couple of deals that I'm thinking about is they didn't have great median incomes. And we thought we were buying in better areas. Now, there's nothing wrong with buying a lower median income, but It's a different business model. It's going to be a lot more tenant turnover, a lot more CapEx. Rents aren't going to go where you think they're going to go. And there's not as much appreciation in those markets. Just understanding that's fine. So buying at a specific price point, executing the business plan. And if you think you're going to hold that asset for the next 20 or 30 years, it's already old. It's going to be even older 30 years from now. So understanding that, that's a great place to start. That's when you start trading up your assets. Hopefully you start older, you start trading up your assets, and you get into newer assets. But for us, not having a crystal clear buy right criteria for the market cycle. When we started back in 2011, hey, you're buying older assets. That's great because the price points are so low. But in 2021 and 2022, when you're buying 4 caps, 1960s assets in Dallas, you're going to have problems. You're going to have issues. So that's not the type of asset you're buying in that part of the market cycle. And really being strict and diligent on what you're buying and don't deviate. Don't what we call pencil whip a deal just to make it fit. Oh, I can get rent growth to go to 6%, when in reality, it's more like 1.5% to 2% now. Expenses are only going to go up by 1%, when in reality, they're probably going up 4 or 5%. Making sure that you have conservative and realistic underwriting will not get you into trouble. And, we've been culprits of that.
Yeah. Yeah, it's and especially if you haven't closed the deal, in the recent past, and you're just itching, you get in, you start underwriting, and you're like, well, maybe we can push this to 5%. It's so tempting to go away from your criteria and not strictly stay with what you know to be true.
It's
in your
alluring.
underwriting.
You're calling the word alluring, and it's the get there-itis. Please. Yeah. I don't know how old you are, Gabe. You're 40 years old.
Almost. I'm 38.
Okay, you're 38. You've probably got another 30 years left in this business, 40 years left in this business. So if you don't close a deal in the next year or two, it's not the end of the world. But we don't think that way.
It hurts. When you're in there, it's like,
you talked about
I want to close a deal.
Yeah, you took my business partner. We closed a deal back in April. I mean, 2 months ago? And he's like, dude, we need a deal. I'm like, we just closed. It's okay. Let's calm down a little bit. That's the dopamine. That's the money strategy. That's the money coaching. Why do you need a deal? It's because that's what fuels you. That little dopamine hit keeps you going. And it's okay, but just understand that dopamine may get you into trouble. That dopamine may make you say, hey, I can get a 10% rent growth and meet an income of 30 grand. That's great. Okay. Just check the dopamine and check what's going on.
Yeah, I'm laughing because I'm in that moment right now. The last deal I closed was in February, and it's not that far away.
No, it's not.
But it's just like I'm looking at other deals, and I'm just like, let's just do it. Let's just do it. It's hard. You got to say no, though. You got to say no. All right, that leads us to the very last question. This is for the listeners. You've given us a lot to think about. I'm sure people want to reach out, get in contact with you. This is a 2-parter. Where can they find you? And then what can they expect when they reach out?
You just mentioned jakeandgino.com. Go there. If you want to learn more about investing in real estate, we have the podcast. We have the Jake and Gino podcast, and we have the how-to. And if you want to reach out to me by email, it's gino@jakeandgino.com. If you want a free copy of the book, just say, hey, Gino, I want a Wheel of Our Profits book, or I want a Happy Money book. I'll send you the PDF copy.
Perfect. I will put those links in the show notes. So if you guys want to reach out, all you got to do is click the little more in the description. It'll pull down the full description. In there, you can find Gino's links. All right, Gino. As always, it has been a pleasure having you on the show. I appreciate you hopping on. And thanks for coming on.
Thanks, Gabe. Appreciate it, brother.
Absolutely. For everybody who's with us today, thank you guys for showing up. You are the reason we do this. So if you guys have any questions, reach out to me, Gabe with realestateinvestingclub.com. If you guys want to support the show, just leave us a review. Other than that, I hope you guys have a great week. Keep rocking real estate, and I look forward to seeing you on the next episode. All right, before I officially sign off, I have a quick announcement to make. If you're interested in becoming a passive investor in one of my deals, my own company, Kaizen Properties, is looking for capital partners for our upcoming projects. We invest in what are known as recession-resistant assets, mainly self-storage facilities, mobile home and RV parks, and industrial properties. If you're interested in investing and would like to learn a little bit more about my company, our investing criteria, and some of the previous projects we've done, go to the Real Estate Investing Club podcast at therealestateinvestingclub.com and scroll all the way down to the bottom of the page. Click on the Invest With Us button. That'll pop up the investor form. Fill that out, and we will reach back out to you as soon as we can. Or if you prefer a little bit more of a personal touch, you can reach out to me at gabe@therealestateinvestingclub.com. So really, that is it. Again, it was a pleasure hanging out with you guys during this episode, and I look forward to seeing you on the next episode.